Hey, what's up, real estate family? Excited for this one. This one's really interesting. I got challenged to a bull versus bear debate by a housing analyst at Housing Wire, and I can't tell you it is really interesting to interact with certain people in the real estate space, but I love it. Let's dig into what is actually going on in the conversations behind the scenes. And by the way, you can watch this all unfold on X. I got my handle at John Brooks, so you can follow me there and you can see what we're talking about. But this article came out in September this year. It was actually circulating in a bunch of real estate agent groups on Facebook, and it was a controversial post because it came out from real estate coaches, Tim and Julie Harris, the 25-year housing surge and why the boom is just beginning. Now, of course, this is the end of 2025, and almost every indicator that we've seen that's come up, especially here in the Sunbelt, has indicated that we're probably going into a correction at a minimum. So how can you see this article and say, I'm just going to leave that alone. I'm just going to accept that people are putting out this content at this point in the market cycle. We need to tell the narrative from the other side and share what we really see happening on the ground, especially here in Florida, because this couldn't be further from the truth of what we're seeing. And I recommend you go check out this article from Housing Wire of what they're putting out. And of course, Logan responded from Housing Wire, "Hey, I want to debate you." And right, he was saying, "Let's put out your forecast and let's debate your forecast. Let's talk about forecasting national prices, local prices. Send me your forecast from the last couple of years." Well, guys, as you know, if you've been following along, I've been involved in this since May of 2025, sharing my opinion of what I've been seeing on the ground. And I'm so passionate about it because I hate seeing the same people getting screwed over every single economic cycle. It's the folks who have 3 to 3.5% down. They're buying in new construction communities, these houses that were just completely slapped up. They're getting pushed in there by low interest rates of something they can afford by getting the incentives from the builder buy downs. And they don't understand that they're buying basically beyond the peak of prices here locally, and they get hit every single time. They're just one job loss or one issue away from their life being totally turned upside down. And the minute they go around to turn around and sell their house, they're unable to do so because they're underwater. And so that is why I originally made this channel, was to share, hey, let me share an alternate point of view that explains what we're seeing here on the ground in the 8,000 transactions that I've done previously, being a top real estate agent in my market recently, previously, and being an investment banker for real estate and doing quant work at a consulting firm. I've seen all of the models. And so, Logan, I would love to see your model. Share it with me. I have my models that I've collected from 10 years ago when I was an investment banker, a real estate investment banker. I'd love to see your models. Let's talk about the variables. Let's talk about the weighting of those variables and the assumptions that you use, because we all know with any forecasting model, those are the key details that drive the output of that model. And secondly, let's dig into the incentives of why we're putting out this type of content. Now, we were pitched this narrative of a housing shortage for a very long period of time. But the reality is the data does not show that. And obviously, if you have two eyes, you can walk around here in the Sunbelt states and basically see there's listings on every single corner. So what do they mean by housing shortage? There's more housing per capita ever in US history, which means housing inventory estimate. This is from Fred, total housing units in the United States divided by the population. So where are we getting this narrative from that there's a housing shortage? We also, by the way, have so many vacant homes. These are the 10 states that have the most homes sitting empty, Florida being one of them. So this is a map of Jacksonville, Florida, where we went from 2,000 active listings, and now we're all the way up to 12,000 active listings. It's like a virus that's spreading. There's more inventory coming on, and the only reason we don't have more inventory right now is because sellers are rage quitting, pulling their listing off of the market and putting it back onto the market next year, and it's pent-up supply that we will see. They're not getting the price that they want. And we're already starting to see areas that are losing home value versus last year. So metros with the greatest share of homes that have lost value since last year. Now, again, real estate, when you're looking nationally, it's really hard to make a national forecast for real estate prices. Every area is so micro and so different than every other area around it. It has to deal with speculators, new construction, demand profiles, unique attributes of that specific area. However, thing to note is that more falling prices in 2026 are expected in these areas that are completely overbuilt, and a lot of these areas in the Sunbelt. So why are certain companies pitching that the market will go on forever? And this is really important for you as somebody who watches real estate news or just the news in general. Before you take advice from somebody, or from a piece of media. Look at the incentive of the person or the company giving it to you. So here's an example. This comes from ChatGPT. I just typed it in. What is this company, this media company that's putting out this real estate information? Well, their revenue streams, according to ChatGPT, come from lenders, title companies, tech vendors, builders, sponsors content, events and conferences, research subscriptions, rankings, award program. So these folks, if they, let's say they were to write a negative piece on real estate, and they kept putting that out there, do you think that they would lose advertisers? It's just a question. Love to hear from you below. Do you think if they put, what kind of advertiser is going to put a bear data that says, hey, things aren't so good. You probably should wait and rent right now when literally their business is to have people purchase. So be aware that there's incentives behind every single piece of media. You make the decision for you for yourself, but the media incentives are not the same as operator incentives. I'm an operator and I'm talking with somebody who's interested in creating media. So what motives does that organization have to pitch that content? And ask questions. When I'm taking advice from a specific person, and it's either financial advice or business advice, big decision advice, I always ask big questions. And number one is, if it's financial advice, is I want to know what their net worth is. I want to know how long it took them to get there. I want to know how many homes do they own? How many have they sold? How many are they renting right now? What is their experience? How many have they flipped? I want to know everything that they have to say about real estate before I'm going to take that person's advice. One person I would love to take advice from who's not here anymore, sadly, is Sam Zell. Sam Zell didn't even know that the 2008 crisis was going to happen. He got lucky. He says it in his book. Okay. There's very few. The Fed had no idea that 2008 was going to happen, and they pointed to all the reasons why we have last time around. And of course, it happened. So what I'm saying is that these forecasting models, they're great and they're good for entertainment, and you're just taking a guess in the dark and saying, hey, this is what I think is going to happen. The reality is none of us know what will happen. However, the fundamentals tell us that things are getting worse right now, not getting better, and it's very, very unlikely, a very low probability that we're about to go on a 25-year bull run in real estate. And that's unfortunately what's still being pitched out there this year, even with everything that you can see, all the data that we show on here, all the data that we show on other areas. And I would love to see the financial models backing these predictions, or the people who vetted this information before releasing it. Share that information so we can have intelligent conversation about these variables and what we see happening in the future. I think that would be an awesome learning opportunity for everybody. This is all about collaborating and making each other sharper so we can all make the best financial decisions for ourselves and for our family. That's certainly why I got on here. It wasn't to create a big mess of name calling or going after anybody or anything like that. It's about learning and becoming sharper and looking at both sides of the argument. And that's why I want to know, what is the other side of the argument? Share it with me. I would love to learn. So what generally drives housing is, honestly, as we know, falling interest rates over the last 40 years have caused up to 80% of price appreciation. This is data that came out by various research analysts, and I can tell you there's other factors. I've done videos on them, about 8 different factors that really drive housing markets on a micro basis. It is not the same across the country. Employment's a big one, interest rates are a big one, and then each area has unique compensating factors that drive that local area. But here's the reality. Right now, prices are coming down. And undeniably, they're coming down. The rate of growth has slowed, and now they're starting to go negative. Another 18,000 FHA slipped underwater in August. This comes from John Comiskey. He's been on my channel. Thank you for coming on. And his data is great because it comes from servicers directly, right? He's looking at data that's coming around the corner that many of us don't have access to at this time. But 18,000 FHAs. We're already seeing 12% delinquency on FHAs. FHA, according to John, is very similar setup to subprime mortgages in the way that they're being executed right now. So keep in mind, even though it's different than 2008 and the setup is quite different, there are some similarities on these loan products, and there's more risk underneath the surface than there may appear at current moment. And remember, real estate data that comes out is also lagging. It's usually 3 months old. People are starting to miss their student loan payments. This is a huge issue. This is going to impact these student loan borrowers, their credit scores, anybody who has a guarantor on there, it's going to impact their credit score. And that's obviously going to impact if they're going to be able to purchase a house. Okay, so this is a big issue. Share of balances past due has doubled as forbearance expires. the Fed and Fannie are starting to, last week we had the 25 bip basis cut, and Freddie and Fannie are starting to ramp up the money printer again. We even just saw that Fannie and Freddie are buying back MBS now and putting them on their balance sheet ahead of their IPO, potential IPO. And so we're starting to see a lot of this manipulation of interest rates, trying to keep the market going for as long as humanly possible. So frankly, the builders can exit their position and they can restart again. And we always do this. We always try to minimize the amount of pain in the short term at the expense of the long term, and honestly, at the expense of the middle class. We've been moving our balance sheet up and up and up anytime we get into trouble, right? We had '08, we had the financial crisis here. Let's expand the Fed's balance sheet and create liquidity, right? Let's keep expanding it, expanding it. Okay, it's getting a little bit slow. A few years later, we started to see some issues in late 2019. Let's go ahead and then during 2020, of course, we had that situation come up, and boom, our balance sheet expands again. This creates a purchasing power issue with our dollars that are turning, frankly, into confetti. And we expanded. And then we started quantitative tightening. This is where things started to change in the housing market, right? The Fed just let these assets roll off of their balance sheet. And now we're back to the point where the Fed is saying, hey, we're going to start creating liquidity again. We're going to start pushing asset prices higher. And this is what we're going to see. We're going to see these predictions come out with these forecasts saying, hey, this is what I think is going to happen. And then the Fed can go a completely different way. And there's the saying, don't fight the Fed. And so the damage is already showing up. Can the Fed minimize it at this point? I don't know. I think there's a lot of distress underneath the surface, especially in commercial real estate. It's definitely happening in the Sunbelt areas with residential real estate, and nobody has a crystal ball. Anybody who guesses or speculates this is going to be wrong a lot of the time. Yes, it's fun to guess. Yes, it's fun to make bets on it, and that's totally fine. And I will put out my prediction there for my local market later this year. And I'm excited to hear what your predictions are for your market. And so go ahead and drop below if you want to put it where your market is and what your prediction is of housing prices next year. It'd be interesting to see. But the reality is the main issue is that the next generation is priced out. It's just so unaffordable for the younger generations to be able to purchase. So you have to ask yourself, who is going to be the next buyer of this residential real estate into the future? When you look at the demographic situation, when you look at the affordability issues that we're having, and you see the wealth divide where the majority of wealth is held by the top 10%, the bottom 90% is struggling. When you talk to people on the ground, they're having issues. And so Gen Z is spending more on essentials than the previous generations. Look at the vehicle costs, insurance, housing, food, and then real wages are just not keeping up with the cost of everything. Of course, this overlays pretty strongly with what we see with the Fed expanding their balance sheet and Congress continuing to spend every single dollar they can get their hand on and more as we continue to load up at $38 trillion in debt. So this is a great chart that shows that wages haven't kept up. You can see in 1985, the ratio 23,000, your median household income to 82,000. Well, now you can see that we've had a 403% increase in home prices, and we've only had a 252% increase in the wages. So the ratios have gotten completely messed up to the point where the next generation is priced out. And honestly, employment is starting to show a lot of weakness, and that is why the Fed is starting to cut rates, among other things. So this is a great headline out there, and people are feeling it. The people we're talking to are scared of losing their jobs. They're scared of AI. Employment picture heading into 2026. This comes from Challenger, Gray, and Christmas, ADP. 1.17 layoffs announced through November. 32,000 private sector job losses in November, and the layoffs are at a 5-year high heading into 2026. So you can see why the Fed is concerned. Obviously, if you don't have a job, you are not purchasing a house, or you're not thinking about purchasing a house. So that's going to impact the demand. Prices are already coming down, and it's spreading across the board across the United States as more counties are experiencing declining home values. This comes from the Reventure. Housing retailers are issuing warning signs. This comes from Home Depot, warns that housing pressures will persist next year. And when housing slows down, it impacts a lot of other industries, including appliance, right? When you buy a house, you're getting appliances, you're remodeling your house, you are making upgrades, all of these aspects of your house, roof, HVAC, plumbing, everything really starts to slow down. And we're starting to see that actually locally. A lot of the flippers and a lot of folks who are doing new construction, they don't have as much work anymore. They're reaching out to us. I mean, in 2020 to 2022, you couldn't get a contractor on the phone. Now those contractors are calling us saying, hey, do you have any work for me? Do you have any work for me? I can cut you a deal. Let's make something happen. They're hungry for work, which is a huge indicator. And Home Depot is starting to see that as well. Here's the chart that shows that those FHA delinquencies are moving up. That comes from John Kaminsky. Thanks for sharing those up. That's huge. We're also seeing that people are stopping to pay their credit cards and they're getting rejected on their credit cards and the fees are so high. They're stopped paying their student loans. They're stopped paying their auto loans. And the last thing they stop paying is generally their mortgage payment. Sometimes people do kind of switch the auto and the mortgage because they need their car. But a lot of cases, their mortgage payment is the last thing that they're going to skip paying. And what we're seeing is a spike in foreclosures of list pendants going out here in Jacksonville, Florida. You talk to the title attorneys around town who focus on this stuff, and they're talking with the servicers and the banks. They're getting hired at a rapid rate. They're building up their foreclosure departments and honestly their short sale departments too, because we are seeing prices coming down. The majority of the pain that we're seeing are those folks who bought from 2022 to 2024 in new construction communities, and they've maybe had job loss or something like that. Their house is now underwater. They can't get out of it. They need to relocate for some reason. And it's about to get worse because the consumer is so maxed out. And this was widespread during these boom years. Everybody just thinks the market's going to continue to move up forever, just like we see with some of these media companies pitching that. It's just not true. This is a market and it adjusts very quickly. And honestly, a lot of the times it's cheaper to rent than it is to buy. And so why would a consumer go buy a house and pay $500, $600 more per month than renting, and they don't have the liability and the overhead? So it's something to think about as well. If you're a buyer in the market, let us know. Is there anything holding you back from purchasing today? Now, this is a really interesting narrative that's happening right now on the ground. We call it rage canceling. It's when home sellers are taking their market off of the market because they get frustrated. They can't get the price that they want. And Redfin did an analysis that showed that 15% of homes were delisted in September and were at risk of selling at a loss. For some reason, they were at risk of selling a loss. Usually this means just against the price that they purchased previously, and it's going to get worse as prices come down. So we expect this ratio to start moving up as well. So this is coming across the board. When we look at specific micro markets, there's leading markets in the industry. Right now, we're seeing that in Texas, we're seeing it in Austin, we're seeing it in Jacksonville, we're seeing it in Raleigh, we're seeing it in areas of Colorado, we're seeing it in Arizona, some areas of California even. And so we're seeing basically rents come down, which is a massive red flag for real estate because it's always an opportunity cost of renting versus buying. So you can see that rents have come down. And it's going to happen to many areas that are in the Sunbelt because they were completely overbuilt with multifamily and residential. You can see this in Austin, Texas. This chart is just horrible. Look at this vacancy just skyrocketing and the rental rates coming down. So this is a huge indication. Now I can tell you here locally where I am, we're already seeing 10 to 15% declines in rents, and we see vacancies jumping to 60 to 90 days. And it's going to likely get worse as we see more inventory and accidental landlords come onto the market. The rental correction in Florida is across the board. Look at this. Fort Myers is down 18% from the peak August 2022 to November 2025. And you can see the markets that are being impacted the most, Jacksonville being one of them. I think this data is a little bit lagging because we're seeing some areas even 20% decline in rents, and this comes from apartmentlist.com, but it seems like it's lagging because the data that we have that we're looking at is very different in specific neighborhoods. Now, it is, again, even in a micro market, it depends on the neighborhood and depends on what's around it, and it depends if they built a multifamily apartment complex, brand new, great amenities right across the street. So talking about forecasts, here's Realtor.com's existing home sales forecast. And by the way, the forecasts keep coming down from these large lead aggregators and media companies that put out this data. So they're seeing it kind of step down every single month. And so they expect the number of existing home sales to increase. I actually agree with this forecast. I think that when we see prices come down and the Fed's going to step in and lower rates, that we will see more units transact. Now, that does not necessarily mean that prices will remain up. I actually think we could see a situation where we're going to see more transactions occur and prices actually come down at the same time, especially here in Jacksonville. So look, I want to hear from you. And thank you so much for subscribing, and you're welcome to follow. I post all these charts and all this information and big questions on X as well if you want to follow me there. The question is, do you believe this narrative that we are in a housing shortage still at this point in time and about to go into a 25-year bull run? Please tell me. I would love to know. And do you think that Logan from Housing Wire will show me his economic forecasting models so we can look at them, understand the variables, the weighting, and the assumptions behind them, so we can really learn where he's getting this information and these predictions that we're going to go into this bull market, understanding that perhaps it may, and up to you, may be influenced by the sponsors of their organization. Can they put out negative information about the housing market and still have media pay them? I would love to hear your thoughts on that and comment down below. Look forward to seeing you next week. Thanks so much for showing up. See you later.